Elliot, and welcome to our third and last series of capital budgeting. In this series, it's again in two parts. We're going to be focusing on risk analysis within the capital budgeting decision. So our key learning outcomes at the end should be able to define the type of risks involved in investment projects, and then also explain the importance of risk assessment and risk adjustment in project evaluations. And then we're also going to discuss the use of probability distributions as well as expected values in risk assessments, and then also determine the sensitivity of the net present value to changes in key variables such as pricing, volumes, variable costs, and discount rates, and also being able to measure the effect on a project's cost returns of a specific scenario, which is scenario analysis. Then we are also going to briefly discuss on the use of decision trees to evaluate projects which involve sequential decisions. So to kickstart, before we kickstart again, some further lecture outcomes: application of equivalence, certainty equivalence, use of discounted break-even and differentiating from the accounting break-even, and then also briefly discussing on the use of the Monte Carlo simulation in analyzing projects, and then using strategic analysis to evaluate the risk of a project. So now the quick question is, what gives rise to project risk in capital budgeting? So it again brings us to the issues around cash flows. So remember, in capital budgeting we said the most important aspect is the reliability and appropriateness of cash flows used in the capital budgeting decision. And because we are going to be estimating these future cash flows, it then definitely brings into play estimation and certainty risk. And then also determining the cost of a project. At times it will not be as easy as it sounds. So for example, if you look at major capital projects that are done, let's say by governments, etc., they always have cost overruns. So it means at the beginning of the project, you are also estimating the cost of a project, which also gives the issues around estimation and certainty. So therefore, looking at these two issues centered around cash flows, it means project risk is measured by the variability of project cash flows. We've estimated the cash flows. If there are any variation in the cash flows, it then gives rise to project risk. So what are the key steps in managing project risk? So the first thing we need to be able to do is to do a risk assessment. What is this? We need to measure the level of risk implicit in a project by looking at the project cash flows. Once we've been able to determine the project risk, we then need to be able to do the necessary risk adjustments. That is by either adjusting the required return or even adjusting the future expected cash flows for the level of risk. So I'm going to kickstart this by discussing the traditional measures of risk. What are these? The use of expected values and probability distribution. And I believe this is something that we have covered in undergrad studies. Here we're just going to focus on how are they then used within the context of capital budgeting as a risk management tool. So we find that projects generally with a high expected value are preferred versus projects with lower expected values. So now the question is, how is an expected value determined? So this is equal to future cash flows times probability of occurrence. So here the idea is, when I'm estimating future cash flows, I don't have 100% certainty that cash flow X is going to occur as is. So I can then attach probabilities to say in year one, I've got a 10% probability that the cash flow is going to be 10,000. And I've got a 90% probability that it's going to be 5,000. So that is the probability of occurrence. So expected value, I'm not saying that future cash flow that I have projected multiplied by its probability of occurrence. Then within this whole discussion, we then bring into play standard deviation. We then measure the variability of those future cash flows around the expected value. So from your mathematics, statistics, you discussed around the concept of standard deviation, how it works from a mathematical point of view. But the only limitation of standard deviation is you can then not compare two projects with different expected values. So standard deviation is more relevant when you are comparing projects with similar expected values. So you've done your expected value, both projects are for 10,000 expected value. And the question is, which project should you pick? So it means the project with the highest standard deviation is riskier. So you pick the project with the lower standard deviation. But of note, it only works if the project has got the same expected values. So to address this problem, we then make use of coefficient of variation. So what does this measure? So this measures the risk relative to the return on the project. So from a calculation perspective, the coefficient of variation is equal to the standard deviation divided by the return. Once we have the coefficient of variation, it is then possible to compare different projects with differing expected values. So a project with a lower relative coefficient of variation means it has got a lower risk. So all these things, I'm sure if you look at it, these are not qualitative factors as part of the project evaluation. Maybe from a quantitative, you've done your NPV, you've done your IRR, you've done your payback. But I was saying, yes, a project might have a higher NPV, but from a risk perspective, it has got a higher coefficient of variation, which may mean that that project may not be as attractive as it initially looks to be. Then, another tool that we can use are decision trees, which are used to analyze projects that involve sequential investment decisions, whose cash flows are ordinarily partially correlated over time. So what do you mean by sequential? We are saying, if I do this and there's this outcome, then I can take the next step. So I can make decision trees and then attach probabilities to each possible outcome. So the project's NPV would depend on the sequence of events. So from the word tree, it means there are going to be a number of possible branches or pathways. And you can end up having a number of possible net present values depending on the path that you have taken. So let's use an example. So I told that HK invests 170 billion in equipment to produce a new product line. And demand is expected to be such that there's an even chance that the project will produce either 20 million or 200 million in the first chance. So even chance, equal chance, 50-50. Then you're also told that cash flows are partially correlated over time. If demand is low in the first year, there's a 75% chance that the cash flow in the second year will be 20 million, and a 25% chance that it will be 100 million. If demand in the first year is high, there's a 35% chance that the cash flow in the second year will be 150, and 65% chance it will be 300 million. And you're told that the project cost of capital is 16%. So I'm sure from this information here, we can see that there are possible outcomes that may arise if we go ahead with this project. So you can then plot these possible outcomes in a decision tree. So obviously from day one, I've got two possible options: to invest or not to invest. If I don't invest, I've not put any money, so I don't expect to have any NPV. But if I put my 170 million, I've got a 50% chance that I'm going to get 20 million in the first year, but I've got 200 million in the second year. So I now have two branches, the one with 20 million and the other 200. And probability is 50%, 50%. If I go ahead with the 20 million branch, in the second year I've got a 75% probability that my cash flows are going to be 20 million, and a 25% probability that my cash flows are going to be 100 million. So red is branching out again. So in exit, I've got pathway A or pathway B. If I go to the 200 million branch, it's again giving me two possibilities: path C and path D. So I've got A, B, C, D. Possible option that may arise from implementing this project. So once I've done that, looking at A, B, C, D, I can then calculate the expected value or the expected NPV. So it means if you follow through part A, our expected NPV would be, our NPV is going to be 137,897. Then B, 78,442, C, 113, D, 225. Now, how do we calculate the expected NPV? So I say probability A1 times probability A2 to get the joint probability, multiplied by the expected NPV for that decision tree path. Then when we add all the expected NPVs, we then get the overall net PV for this project, which is 31,000, a positive NPV. So the assumption here is, for this project, given that it has got a combined expected NPV of 31,000, we should accept. But in practice, however, you should then consider, okay, we have said the overall expected NPV is 31,000, but we've got 2% that our NPV can actually be negative. And we need to take into account that qualitative factor. So when you're looking at decision trees, those are some of the issues that may then come into play. Yes, I have an expected value, but it is taking into account the various probabilities. So this is just a starting point for management to make a further decision on whether or not to invest in this capital project. So next step, we're going to go to, please do make sure you go to part 2 of this lecture recording, where we discuss additional tools around risk management in capital budgeting. Thank you and see you in part 2 of this recording.